My CPA said I qualified for real estate professional status. However, the state auditor disagreed. Here's what happened next. You see, that sentence came out of an email I received from a real estate investor a few months back. 2 rental properties, right? Husband, he's a doctor, he's making 6 figures from his medical practice, and he's doing what a lot of people do, is that he has his spouse managing the rentals. You see, their CPA had been claiming real estate professional status without, or what we call, reps for 3 state years on the wife. Now, then a letter shows up, not from the IRS, right? It's from their California state auditor. And that letter is what started the whole thing falling apart. You see, in this video, I'm going to walk you through 3 tax court cases the IRS is leaning on right now to deny reps status. And we'll cover what your CPA almost certainly hasn't told you about how state auditors trigger federal audits, including which states you are actively hostile to this strategy. And by the end, you'll know exactly where your own filing is being exposed. Okay, so let's first talk about the rep status, what it actually is, so we're on the same page here, because the people getting hurt usually do not understand what this means. And I run into those people all the time at my events who tell me, I qualify as a real estate professional. I say, well, what do you do? Oh, I work full-time as a fireman, and then part-time I work for Uber, and then on the side I do real estate. I'm a real estate professional. Now, some of you are probably listening to this going, there's no way that person qualifies. But it's the aspect of reps is really important that you understand when it's going to fit with what you're doing. You see, where does this come from? It comes from section 469C7. Yeah, I coded an Internal Revenue Code section there. And it's the only meaningful way a high-income taxpayer can use rental losses, including big depreciation, deductions from cost segregation and bonus depreciation, which is huge right now, to offset W-2 income or business income or anything that you have out there income-wise. Now, without reps, and this is why this is so important to people, okay, your rental losses are passive, all right? That means they sit on Form 8582 and they don't go anywhere until you have passive income to absorb them. So what does that mean? It means that if I have a rental property and it brings in $10,000 a year, but I have depreciation deductions and other expenses amounting to $18,000 a year, then I have an $8,000 loss. Unless I have other passive income to offset that, maybe from another rental property, then I can't write that off. So people want reps so they can claim that $8,000 against their other forms of income. Now, in order to qualify as a real estate professional, you have to clear 2 hurdles, all right? Not just one of these, you have to clear 2. Okay, so the first hurdle is you have to spend 750 hours a year in a real property trade or business. Okay, that's the first hurdle. So it's got to be real estate related. Now, the second thing that you have to do is spend at least 50% of your time on real estate related activities or that real estate business activities. So first you qualify this, right? Then on top of that, you have to materially participate in each rental that you own, unless you make what's called an aggregation election. And I'm going to come back to that, so don't worry about that right now. Now, here's what's really important. Okay, it's in the regs of section 469. And here's the part that most CPAs just kind of gloss over. It's that this rep status is a year-by-year test. So it's not as if I qualify in 2026 and once you get rep status, then it carries forward. And it doesn't matter how much time you spend in 2027, 2028, going on. All right, you have to qualify each year. It's not an automatic qualification once you've done it. So it means you have to prove it every year. And so this brings us to case number 1, and probably the most expensive reps lesson for someone coming out of the 2025 tax year. Now, this case, Mirch v. Commissioner, all right, it came out at the end of 2025. And here's what happened. See, these taxpayers were a married couple, both attorneys running a law firm in Reno, Nevada. And the wife claimed rep status to offset their law firm income with losses from 2 rental properties. Okay, a student rental in Rhode Island and a short-term rental near them in Reno. Now, here's where the problem came in for these taxpayers. You see, the husband, who had an LLM in taxation, was also a CPA. So it wasn't as if the couple didn't know any better, and that may have influenced the court a bit in reaching their decision. But the problem was in how they logged their hours to show reps. That was one issue they had. See, for the short-term rental income, what they were doing, as the wife was claiming, is that she spent 7 hours to clean the property after every stay. And she listed that she has 8 hours of site management for every day the property was rented. All right, so total claimed for site management was 744 hours. Now, the court read the definition the taxpayers gave for their on-site or site management, because it's not even on-site. And here's what the court said, found it so interesting. He said, on call for guests, repairs, supplies, Wi-Fi, cables, snow removal, right? On call. That's what they were counting. That, hey, I'm just available by phone. So if somebody runs into these problems, I'm working for that property, so I'm always on call 7 hours a day. See, the tax court threw that out. The court ruled that just being available on a call does not count towards the 750-hour requirement. Not for the short-term rental exception, not for material participation, and obviously not for reps. And so once they stripped out the on-call hours, the wife was nowhere near, of course, the 750 hours, so their losses got reclassified as passive. So, back taxes, penalties, interest, and a federal tax lien. So here's the lesson you should learn from this case. There's a giant gap between the hours your CPA may tell you, especially if it's your husband, that count towards what actually counts under audit. And available to handle problems like this woman was doing here where she's on call, they don't count. You can't say that, hey, I spent time thinking about my portfolio, right? I think about mine 100%, 24 hours a day. No, it will not reach the minimum bar here. So researching new properties to buy, that's investor time, not operator time. And unfortunately, that doesn't count either. And I run into people all the time who tell me, hey, I'm out there, I'm investigating, so I'm keeping track of those hours. That won't get you there as well. So there is a way to track and categorize your hours that will survive an audit. And there's a clear line between investor activity and operator activity that most logs completely miss. And this is something we see in our tax department. And that's where we work through on a strategy call to make sure that people understand you got to create these logs, documenting your hours, and you have to do it right. One of the other problems in that case you probably recognize is that the wife stated 7 hours per turn, okay? Now, you can't just pick a number, an arbitrary number, and say, this is how many hours I spend every turn, because it's not always that way. If you have somebody leave your property and they left it spotless, all right, you're not going to spend 7 hours that day. Maybe that's a 3.4 hour day, and then maybe there's a 6.2 hour day. Round numbers also hurt you. So let's talk about case number 2, and that is Drusilla v. Commissioner. Now this one is pure math, all right? That's all it is. And it's a case that catches white-collar professionals, doctors, and other individuals more than any other. You see, the Drusillas, all right, they were a married couple. Again, see the common thread here? Both worked full-time at W-2 jobs. They claimed 1,500 hours of real estate work between them. Now, here's the thing. When you're married, you can group time. So that's permissible under the code. And their CPA looked at the 750-hour test, and they said, hey, you cleared it. You're golden. But the 750-hour test is only half the equation. The other half is at 50% of your time on a real estate-related activity. And here's where the math becomes important, okay? So, full-time W-2. You work roughly 2,000 hours a year. So to pass the 50% test, you need to spend 2,001 hours in real estate. They claim they spent 1,500 hours or 1,501 hours. So they lost, and that's where it gets worse. See, not only did they not meet the required minimum hours to show 50% of their time, they also were not keeping an adequate log, like I talked about earlier. They weren't precise in their documentation. And on audits, the IRS looks for logs of time that you're spending, on your W-2 hours as well, so you got to document that, plus how much time you spent on real estate-related activities. So what the court did, okay, what courts do is they assume that they were full time. So they worked 40 hours a week, 2,000 hours a year at their W-2 jobs. Now, if you work part time, you need to back that up. Keep adequate logs. Keep whatever your employer provides you to show if you're hourly. If you're salary, that's more of a problem. So that's why you got to keep a log showing, I went in this day and I only worked 3 hours at the hospital this day. This other day I worked 5. This day I worked 2. That's important because the assumption is that if you just are a W-2 wage earner, you're working 40 hours a week. So what that puts you at is at 2,001 hours. So they could have possibly made it, but they didn't because they didn't have that log. Okay, so what should they have done? Well, of course, as I stated, keep a log of their time, but maybe one spouse steps back, right, from their job. If they're on salary, asked to go on hourly or something like that. So it helps buttress their claim that they did not work more than 50% of their time on a non-real estate activity. So you're going to scale back your time. So one spouse should do this, and you're going to want to document it. So typically that means the high income earner is going to stay in their job full time, and then the lower income earner would pull back. Now, the spouse angle is where most of our high income earning clients typically land, and there's a structural reason why they do this strategy that will typically survive audit when it's set up right. But that's a conversation that we have to have, and that's why we encourage you, hey, if you're watching this YouTube, you should really reach out for a strategy session to go through that. Now, there's one more case that ties everything together, and the rule it created is the rule that auditors use all the time to flag reps' claims faster than anything else. Now, this case, and I'm going to butcher the name, it's Seznov v. Commissioner, and this goes back to 2022, but it's still the gold standard that's running through tax court cases here in 2026. And the Mirch decision that I just talked about at the very beginning that we just covered cited this same principle. You see, in that case, the taxpayers, individuals, had no real-time logs. And when the audit hit, they tried to reconstruct what their hours had been, emails, receipts, calendar entries, and memory. And the court used a phrase that has now become the standard in reps audits, right? Post-event ballpark guesstimates, all right? That's what the court called it. That's what they say whenever you try to reconstruct something, and they're going to throw it out. That's why I said you have to do this contemporaneous with your time that you're spending on your property. And so what auditors are now applying this. And if your log was created after the audit started, it's presumed, of course, that it's unreliable. That's it. There's no way to say that your memory is that great because none of us can remember what happened on a Saturday in the month of January, the third week of January, 2 years ago. And this is what most people do not see coming. If your log looks too clean, and so I've seen this before, people come to me and they'll say, well, I keep a log. I'll take a look at it, and you can tell. They sat down after maybe a year or maybe 8 months, and they just went down, they started writing everything down. Same pen. Right? Same handwriting. It looks too clean. So one of the things I recommend you do when you're creating your logs, use different colored inks, blue pen, black pen, pencil one day, and make sure that when you look at it, it's not so neat and clean, unless you're an engineer, and so that's expected of you, that someone's going to know you just recently put it together. So that's what we need to look out for, because otherwise they're going to assume you fabricated it. Okay, basically what courts want, I hate to say this, is they want messy, right? Logs created in real time, variations, right, from week to week. So it's not always the same amount of hours on the same types of days, things that I've already been covering. These are all important. That's what's going to survive audit. So these are the three cases that you need to be aware of. On-call doesn't count. The 50% rule eats W-2 wage earners alive. And of course, the reconstructive logs at the end are thrown out, as the court said, guesstimates. But here's where it gets worse. And this is what I started out about with that email. And it's a part that nobody is talking about on the internet. And that is, up to this point, we've only talked about the IRS, but the IRS is not the only agency that audits your tax return. Your state does too. And here's the part that catches people. When a state auditor denies your reps claim on your state return, in most states, they share that finding with the Internal Revenue Service. And so think about this. So many states are running budget deficits. So if you've claimed rep status, yeah, maybe the IRS accepts it because they're understaffed right now, but your state They're not. They're looking for every dollar they can get. They see that return come in, they start digging into it. They determine by auditing you, you don't qualify, then that goes back up to the feds. So now you got a federal audit that's triggered by a state finding. And then they have all of the state auditors' analysis right on the desk before them before they even open your file. So this is the trigger. And the IRS is the consequence, unfortunately. So you planning for the wrong one if you always think it's going to be the IRS. If you have a state tax, that's also the issue. So this example that I was talking about, guess which state it came out of? You got it, California. Okay, one of the most egregious states when it comes to imposing taxation on their citizens. But they're not the worst one, all right? Well, actually, it is the worst one, but you also have New Jersey and Pennsylvania. California by a wide margin. The problem is that many of these states, like California I brought up, is they do not conform to Internal Revenue Code Section 469 that I brought up earlier about the ability to turn passive losses into non-passive. Understand that. They flat out reject the ability to qualify as a real estate professional. So if you live in California or you own California rental property, your rental real estate is treated as per se passive for state tax purposes. So even if you qualify within federally as a real estate professional, right, the Franchise Tax Board will say your rental losses cannot offset your wages on your state tax return. And here's the kicker. As I stated, California is not the only one that does this, right? Pennsylvania and New Jersey also do not follow that as well. So these are things that you have to be aware of when you're filing your return. You have to know your state law, because this can create major problems for you if you're thinking, hey, this is going to offset my state taxes, but your state doesn't follow that position. So here's the bottom line. Even if you build it so it's bulletproof, right? Federal reps position, you still may have a state level vulnerability that becomes the audit trigger. And your CPA, especially if they aren't a state tax specialist, almost certainly hasn't run the state conformity analysis on your file. So what do you actually do about this? Well, I don't have time to go through the full playbook that we use here at Anderson. Okay, that's why you, as I stated earlier, you want to get on a strategy call. And we have the ability to do that in the show notes. All you got to do is go down there and you can click on a link, and it allows you to structure a call with us, and we can walk you through how to go about claiming rep status the right way. And listen, there's no one-size-fits-all approach to this, but there is a framework that we run all of our clients through in order to make sure that they can qualify for this. Or maybe you can't, but we'll figure that out when we're all on a call together. More importantly, we'll talk about something that I mentioned briefly earlier, is the aggregation election. Listen, if you're a real estate investor, you have multiple properties, and you didn't file this election, I've seen this a lot with individuals who have come up to me before, and they said, yeah, I definitely qualify for reps, Clint. I understand everything you said in the event. I checked all the boxes. My next question to them is, have you submitted an aggregation election? Okay, you have to prove material participation on every property if you haven't, because what you're doing there is you're aggregating all of your real estate as one activity. And if you have to go back and prove material participation, that means, hey, you're spending 500 hours per property, and that's not happening. So if you're watching this right now and you're a rental real estate investor, make sure you're having a conversation with your CPA, asking them about the aggregation election and has it been submitted on your behalf. All right. And if you do that, I think you're on your way to making sure that you can reap all those great benefits that come from being a real estate professional and then claiming cost segregation and bonus depreciation, rather than putting your head on your pillow at night and wondering, hey, am I just another day until I check out my mailbox and there's an CP11 notice sitting inside of it. I wish you the very best with your investing, and be sure to like this video if you like the content. And if you're not yet a subscriber, now's the time. Take care.